The stock market is at all-time highs, yet crude oil is still above $95 a barrel. These two asset classes are telling entirely different stories. As a former hedge fund trader, I can tell you that while they can trend in the same direction for a while, eventually one of them is going to face a brutal repricing. The Strait of Hormuz remains compromised, strategic inventories are rapidly depleting, and as of today officials are meeting to decide on the US military operations in Iran. Yet Wall Street has chosen to completely ignore the most critical inflation signal of the decade. Look closely at this chart. Higher crude oil prices create dollar demand, which forces the dollar up. The longer crude oil stays elevated, the stronger the dollar becomes. A higher dollar acts as a global liquidity drain, which sooner or later will pull down asset prices. So, the longer oil stays above $90, the more likely is that the Fed will be forced to hike rates again. And a higher dollar combined with higher rates will crush equities. This is exactly the opposite of the soft landing fantasy the market is pricing in right now. Look at this strip. The oil market is in a backwardation. 1 month oil is more expensive than 6 months oil. That is not a futures market pricing in a quick recovery. That is a market pricing in a severe physical shortage. The International Energy Agency just called this as the largest supply disruption in history. Not the largest this decade, the largest in history. Millions of barrels per day have been removed from global flows. And the strait is not recovering. 61 days in, commercial cargo crossing through Hormuz remains severely depressed. Look at the actual numbers. Most CEOs you see on Bloomberg expect normalization by the summer, but we're entering May with absolutely no sign of recovery. Meanwhile, OECD commercial crude inventories are in a freefall. The global oil buffer that was supposed to absorb this exact type of shock is disappearing fast. Buffers heading down is not a narrative, it is a hard inventory data. In October 2025, I laid out the exact mathematical case for crude oil to hit $100 a barrel. The mainstream ignored it, but it happened anyway, so if you want to front-run the data instead of reacting to it, hit subscribe. Here is where it bleeds into the broad economy. The PMI index, the leading indicator for consumer inflation, is ticking back up. This is the inflation pipeline at work. Energy costs pass through to transport, transport passes through to goods, and goods pass through to the CPI. March CPI came in at 3.3% and the energy component was the primary driver. The Fed's funds rate is sitting at 3.5 to 3.75%, but the 2-year Treasury yield, the Fed's favorite gauge for interest rate expectation, is trading well above that range. That spread is telling you the bond market does not believe the Fed can hold rates, yet the equity market is still not pricing in rate hikes before year-end. Overlay crude oil, overlay the dollar index. The dollar is at 98, so every sustained oil shock in history that forced the Fed to tighten into a supply shock produced a stronger dollar. And again, a stronger dollar means a liquidity crunch. The Federal Reserve is in active discussions with the UAE Central Bank about an emergency dollar swap line. Let me translate that for you. The UAE sells oil in dollars. Disrupted oil flows mean disrupted dollar revenues. If United Arab Emirates cannot generate dollar income, they must sell US assets to maintain their dollar peg. That selling of treasury is exactly what the Federal Reserve is trying to prevent. Collateral is declining globally. The lubricant of the financial system, high-quality collateral, is being drained. The Treasury is buying back long-term debt and issuing T-bills. The Federal Reserve on the other side is buying those bills. This is stealth QE. It is injecting short-term liquidity into a system that is simultaneously under massive pressure from three different directions: the Middle East, Europe, and Tokyo. And the software convexity trade, the rate market's internal stress signal, is elevated. The bond market is terrified, even as the equity market remains completely complacent. Here is the strongest case for the bulls, and why we are at all-time highs. Goldman Sachs estimates that systematic funds (CTAs) are at $86 billion of US equity exposure in a single 5-session window this month. It was one of the fastest reallocations of record. The market entered a positive gamma regime where dealers were mechanically forced to buy dips. The short squeeze was real. However, the Bank of America indices are now flashing severely overbought signal. The S&P 500 trailing price-to-earning ratio is above 30, the forward price-to-earning ratio is around 21, well above the 10-year average. Even Berkshire Hathaway is sitting on record cash. The smart money right now is hedging. But look at the retail. This is Fidelity and Bloomberg call-to-put ratio data from last week. With S&P at an all-time high, the 5-day ratio has just spiked back to 1.5. Retail option buyers are flooding into calls at the exact moment the market reaches peak valuation. Notice how the crowd is heavily positioned for the market to just keep going up. This is textbook Euphoria. Here is where it gets interesting. Goldman's own trading desk issued a simultaneous warning regarding mechanical pension fund rebalancing for the last week of April. Pension funds must mechanically sell equities and buy bonds to achieve their target allocations after the historic rally. The CTI buying cushion is now completely depleted, and the gamma shock absorber is operating at the maximum friction. There are no marginal buyers left to absorb this pension selling. Semiconductors, the poster child of this rally, are severely overbought. Everyone is already long, and the data from Bank of America just confirmed that. And then there is this. NFIB small business capex plans for the next 6 months have just collapsed to the lowest level since the global financial crisis in 2008. The Main Street economy is not preparing to invest, it is preparing to survive. The financial market and the real economy are now disconnected completely. But keep in mind, I'm not saying a crash is coming. I'm just saying that currently equities are way overbought. But if the Strait of Hormuz magically reopens within the next 30 days and crude oil drops below $80 a barrel, this entire framework changes. The Fed does not hike equities hold, but the market is pricing that as near certainty, and the data does not support certainty. So the market has exactly 10 days to decide if this oil shock is temporary or permanent. The date is May, that is the next CPI release. If the energy component remains above 3% month over month, and with crude oil above $90 now, this is mathematically a certainty, the Fed cannot cut rates. So every single rate cut expectation currently priced into this market gets repriced in a single morning. Watch the 5-year break-even inflation rate from the Fed. Watch the 10-year yield, so if both move higher on the same day as the CPI print, the bull thesis is officially dead. The mechanism is not new, so follow the data. See you in the next one.